Welcome, everyone. I'm Diane McKeever, and this presentation is brought to you by the Minnesota chapter of SCORE. Today, we have a wonderful presenter, Alan Gorelick, who has been with us before and does a fabulous job. So we expect nothing more than perfection today, actually. Before we get started, I have to do a little background. So Alan, if you just click once, I can get to the next slide. Just a little bit about SCORE. You may not be familiar with our organization, but it's a nationwide nonprofit, and we provide America's small businesses with free, always free, confidential business mentoring, both in person and online. We have a lot of resources to help you. Nationwide, there are over 300 chapters. Our chapter is the Minnesota chapter, and we serve Manatee and Sarasota counties for over 50 years. Although I don't know about Alan, but I know that I have clients from outside the area as well. So you can have actually a mentor from anywhere in the US that best fits your needs. And our chapter was recently recognized as a district chapter of the year. Next slide. There we go. So when would you contact SCORE to help with your business? Well, pretty much all the entire time, whether you're thinking about starting a business or you actually have started one and realize that you need a little bit of help, or you want to grow your business, or lastly, you want to sell or close, or conversely, thinking about buying a business. That would also be a good time to apply for a SCORE mentor, because we have a team that's dedicated to just those activities. So whatever it is, wherever you are in your business, if you have a business question, consider applying for a SCORE mentor. Now, where would you do that? Well, you'd go to our website. If you go to score.org/Minnesota, you'll see a big old button to request a mentor. You'll click on it, fill in a little bit of basic information about who you are and what you're looking for, and a mentor will be assigned to you within a few days. They'll be contacting you and you'll be off and running. Lastly, I'd like to thank some people that help us pay the bills. Our sponsors, and you'll notice that a lot of them are financial institutions. If you go walking into one of these places with a SCORE mentor, they're going to listen to you a lot more than they would if you walk in with a whole bunch of papers in your hand and hand it off to them and say, I think I'm eligible. What do you think? I also like to thank our community partners that help us spread the word about SCORE. Now, I think it's time, one more click, and I think you are on, Alan. Take it away, Alan.
Okay. Well, thank you all for attending. I wanted to start with this slide here, because it's one of my favorite stories about Jack Nicklaus. And I think it's I could just picture him doing this. And we want to do that too. We want to come up with a process for you where you can do your own balance sheets, understand your own company. And so we want it to be reasonable. And as we say here, and we're hoping that when you're done today, you'll have results that you can use. And this webinar came about as part of a series. I think it's the third one in a series, where people have said, well, you guys do a great job teaching us how to read Amazon's balance sheet or learn about how much profit Tesla made last year. But what about my own company? What financials do I need, and what can I learn from them? And so we've been talking about budgeting and profit and loss, and this one is the balance sheet, and we're going to show you how to build it. But I think more important than knowing how to build it is knowing what information about your own company you can glean from the process of building it. And that's why we have several steps, but they should be things that you can take to heart and actually do. And so for today's process, we're going to actually build it. We're going to start at the top left, and each item on the balance sheet, we're going to explain it. We're going to put it in context. We're going to give you some ratios, some comparisons. And I don't think a presentation like this would be complete without sharing some gotchas. So you look at the two pictures, we're going to count a lot of beans, and We're going to do it in a very structured way. We're going to go right down the line. And your balance sheet is a snapshot. It's not a flow. It's a snapshot of that second in time. So literally you could do one every 5 minutes. I don't know anyone who does, but you could, because it changes. Certainly you want to do one every year, probably every quarter. If you're a new company and you're watching your cash very closely, maybe you want to do one every week. And because we're so computerized, it's not a big deal to just make the changes and look at another weekly balance sheet, or at least know your cash. I've run companies where you could wake me up in the middle of the night and ask me how much money we have, and I could tell you. I might not tell you my name or where I am, but we always knew how much money we had. And I think that the balance sheet will give you a lot of that kind of information. And hopefully you won't have to wake up in the middle of the night to say, oh my God, I don't have enough money. And the balance sheet, most of them are built like this. Your stuff is on the left side, it's in a column. And on the right side, your debts are at the top and your equities on the bottom. Now, sometimes you'll see the assets on top of the debt and equity rather than left and right. That's fine too. There's no requirement that it be left and right. But I think it's easier to picture balancing if you realize that it's like a scale. The stuff on the left has to balance with the stuff on the right. So I think that's a better way to produce it. And it's also easily done on a spreadsheet. And I know when I first present this to my students, it seems like such a weird concept that, well, what do all these words mean and so forth. But if you think about it, if you own a home, everybody knows how to do this math, right? The house is your stuff. That would be on the left side of your balance sheet. Then on your right side, you have your mortgage. And what's left over between the value of the house and the mortgage is your equity. And if you own a house, most people can tell you what their equity is. They maybe not to the dollar because they don't know exactly what their house is worth, but they know pretty close how much equity they have. And it's really the same concept for a company. Also, it's a pretty nice house. One of the differences, though, between this house and any company's balance sheet is generally when you look at home ownership and figure out the balance sheet for your home, you look at what the home is actually worth. Whereas on a company's balance sheet, rather than looking at what things are worth, you look at, and we'll talk more about this in a few minutes, but you look at what you paid for it minus depreciation. So that may not have anything to do with what it's actually worth. But other than that, it's a pretty good analogy, and I think you can get the idea of what we mean by owner's equity. So when we're setting up the balance sheet, we've got some rules. We're going to have the two columns, as I mentioned. In each column, we start with things that are closest to cash, or most easily turned into cash in the shortest amount of time. And then incrementally, as we go down each column, we get further from cash or further time to turn it into cash. And on the asset side, we have a breakpoint at a year. So we go from what we call current assets to fixed assets. And these are just names that have been assigned. When we go through it in detail, you'll see that fixed assets may not really be fixed, and the current may not be that current, but these are the words we use. And then on the right side, we start again closest to cash or closest to using your cash. You start with your current liabilities, and then we have a break point again, usually at a year, where we go to what we call long-term debt. And then at the bottom right, we have our equity. And as I mentioned, we carry our fixed assets at the acquisition price minus depreciation. So it's almost impossible your assets are going to equal your market value. I mean, it would just be a random miracle. And that's unfortunate, but that's kind of how we do it. The last two bullets are very important, though. Every change requires at least 2 entries because your debits have to equal your credits. That's just a rule. So if your debits don't equal your credits, your balance sheet won't balance. And if it doesn't balance, it's not done. And again, because I've been doing this a while, I've never had a company do this, but I've had students turn in balance sheets that didn't balance with long explanations about how the world they're describing isn't balanced, but it has to be. So obviously they didn't finish. And you want to make sure yours balances. So starting with the current assets, we start with cash, because what's closer to cash than cash itself? And got this nice little pile in this picture. Of course, we don't know how much it is. It looks like there's a lot of money there, but you got to look deeper, because maybe there's a 20 on top of the pile and everything else is ones. So maybe it's not as much cash as you think, or maybe they're all hundreds and you're doing great. So you got to ask the question, do we have enough cash? And if you want to know if you have enough cash, you got to forecast how much you need. We've got some webinars on how to forecast your cash requirements. And I would highly recommend you take a look at those if you're not sure how much cash you need. But then the other question is it liquid, right? So maybe you have lots of cash, but it's in CDs. And these CDs are going to mature in 18 months. Well, then you really don't have that much cash if you were to need it right away, unless you could easily get more. So you need to really not just look at the amount, but where is it kept? And then on the other side, if you have the happy news that you've got too much cash sitting around, well, at least earn interest on it. You can do very nicely now. You can earn 5% on your cash, taking very little risk. You don't have to put it in a CD that ties it up. And in almost every entry on your balance sheet, you want to compare it to a previous period. That's how you create a flow. Remember, the balance sheet is a snapshot. So if you say, well, I've got 50,000 in cash now, how much did I have last week? How much did I have last month, last year? How much am I going to need next year? The flows are important, but they are created by comparing one snapshot to another snapshot. Next is the receivables. We put that next because we believe that we're going to get paid. We sold something, we're going to get paid for it. Now, a lot of cases you get paid right then, or maybe you take a credit card and MasterCard or Visa pays you that night. So you're still paid immediately. But a lot of businesses don't get paid immediately. There's a delay, and we call that delayed money receivables. And it's a receivable whether people are paying you on schedule or they're paying you late. It's still a receivable and needs to be on your balance sheet. And the way we like to measure it is what we call days sales outstanding, which makes it sound like something good, right? Anytime you use the word outstanding, it sounds like a good thing, but we mean not so good. It's outstanding. And so if, just to keep the numbers simple, let's say that you're selling $1,000 a day of goods and your receivables are $20,000. So then your days sales outstanding is 20 days, right? And you might be wondering why I put these two desserts on the slide. And I was wondering about it myself after I did it. But I decided that actually it makes the point that who's going to get the dessert, you or the people who owe you the money. You want to make sure they pay you so you get the dessert, because if they have the money, you don't. And you have to look for trends. Are your receivables getting longer? Are people paying you even slower than they used to? Are they paying you faster? And then once you've got day sales outstanding, you can say, all right, I'm doing $1,000 a day and I have 20,000 in receivables. Well, if I could bring that 20,000 down to 15, that's another 5,000 that I would have in the bank instead of having it owed to me. And maybe that would make all the difference looking at that first line between how much cash you have and how much cash you need. And collecting on receivables, it's an art form, and I'm not suggesting you send guys with baseball bats to break kneecaps, but you can if you want to. But sometimes just making the phone call, just saying, we had this invoice and I noticed that you were supposed to pay last week and you hadn't, and I'm sure it's just an oversight, but if you could give us that, pay us now, that would really be appreciated. And you'll find that that's very often, that's all it takes. People just need that little nudge and they will pay you. Or maybe they didn't pay because there's a reason. There's something they're not happy about. They didn't tell you. Well, now that you've called and asked for the money, they'll tell you, well, we would have paid on time, but it keeps breaking and you call for help and your help desk isn't very helpful. And that's something you really need to know. And maybe if not for the receivable being late, you never would have known that. And then right along with that, of course, is inventories. And inventories include both work in process, so things you're building that aren't finished yet, as well as finished goods that are ready for sale, whether you bought them from somebody else or whether you built them yourself. If they're sitting there waiting for sale, they're part of your inventory. We want to measure the inventory turns per year as well to see how well you're doing. Is it just sitting around or is it moving quickly? And so some people look at the ending inventory at the end of the year. Some people look at the average inventory. I mean, either one is fine, but instead of comparing it to sales, you compare it to your cost of goods sold. So if your inventory is $20,000 and your cost of goods sold is $100,000, well, then you've turned your inventory 5 times a year, and that's pretty good. But what you really want to do is look at what I call take a hard look. Which products hardly ever sell? Maybe you shouldn't be keeping them in inventory for that one client a year who comes along and really wants it. And you want to say, oh, great, we've got one right here in the back for you. Maybe you disappoint that client, or you tell them you'll have it for them in a week, and don't tie up your space and your money with products that hardly ever sell. And then on the other side, if you're always running out of something because it's so popular, maybe you ought to have more of it around, because somebody else is going to come along and figure out a way to stage it faster. And of course, if you can stage it fast without owning it or warehousing it, that's great. When Amazon started, they didn't have any warehouses. They didn't have any books. You bought a book from Amazon, they went to the publisher and bought it for you, and then they shipped it to you. And in fact, in those days, sometimes they lost money on a book. Obviously, they had a plan, and the plan worked out. But initially, they didn't have big warehouse. They made it seem like they did. So, well, if you buy this book, we'll have it for you in 5 days, because they knew they could have it in 2 days and take them a day to literally hand wrap it, take it to the post office or to FedEx, and send it to you. And over the years, we've learned a lot about how to be efficient with our computers, and we've put in just-in-time inventory so we don't have a lot of stuff. And then, the pandemic came along with the shocks to deliveries, and companies said, maybe we ought to have a cushion. We don't want to be in a place where our stuff is on a ship at LA Harbor, and that ship's not going to be unloaded for 2 months, which of course some companies just went through. So you have to balance the two. But the important point is, look at how much inventory you have, look at how fast it turns, and put your money where it can do you the most good. And of course, if you prepaid any expenses, that's an asset because you own the rights to something. Maybe you prepaid legal fees for a year, or you prepaid insurance for a year. Well, now it's an asset because you own the rights to that thing in the future. I just would say, if you're going to prepay, do it for a reason, because you got a good deal. Maybe you needed a tax write-off right away, but don't just do it because it's December and you got a bunch of bills on your desk and what the hell, I might as well pay it, because then somebody else has the money instead of you. Okay, so that's the current assets. That's the stuff that we feel we can turn into cash in a year or less. And there's no rule about a year, but that's kind of the common practice, that we look at a year as the cutoff. So now we have our fixed assets. And so, as I mentioned, we first list what we paid, then we subject it to depreciation. And fixed assets don't really mean they're physically fixed. Trucks are still fixed assets, and cars are fixed assets. By fixed, we just mean they're not current assets. And we subject them on our balance sheet to depreciation, even though we know we may not be depreciating them at the rate they really depreciate in the real world. In fact, they may even go up. If your inventory is airplanes, 747s or 787s, they're probably going to go up in value, but you're still going to depreciate them, because that's what we do on balance sheets. And you depreciate according to a schedule. You can depreciate at, literally the same amount every year. You can depreciate more in the early years. If you do have separate tax books, you want to depreciate faster on your tax books than you do on your regular generally accepted accounting procedures books. And that's legal, by the way. A lot of accountants don't even know this unless they do accounting for corporations, but you are allowed to have two sets of books. We're not talking about Al Capone kind of books. And so what you want to do is on your tax books, you want to say to the IRS, man, we had a terrible year. I don't know how you could possibly expect us to owe any taxes. And on your regular books, you want to say to your investors, we are doing great. We are just making profit hand over fist. And you're allowed to do that as long as you're consistent across products, you're consistent over time. And on your tax books, there are rules. You can't just make up a depreciation schedule that makes it look like you haven't made money ever. There are rules for how you can do it. On your GAAP books, though, you can really be creative as long as you're consistent and it makes sense. So here are the three lines that would appear on that left column toward the bottom. For each item, you have the purchase price, then you have the depreciation, and then you have the book value. And as I mentioned, it has little relationship to the actual value of those assets. And it's one of the reasons the book value of a company is different from the market value of the company. Now, of course, there are other reasons too. The market value encompasses the fact that it's a going concern, has clients, and things like that. But one of the reasons is that the book value is less than the market value. And I'm going to mention it in some other contexts a little bit later as well. Then you have intangible assets. And I'm not going to read them all, but you can get the idea. These are things that don't kind of fit in any other category, but you certainly want to mention if you have them, especially things like patents and licenses. Goodwill is one of the gotchas on a balance sheet. And in all the years of teaching, when I ever ask my students, what do you think goodwill means? Not a single student has ever guessed right. They always assume it has something to do with charity or being a good person. Or we all know about the Goodwill stores where you can bring used items and they sell them and use that for helping poor people. But goodwill on a balance sheet comes from when you buy out another company for more than its book value, which you're almost always going to do, right? If there's another company you're interested in, and you really were only interested in their tables and chairs and trucks and things like that, well, you'd buy the tables and chairs and trucks. You wouldn't buy the whole company unless there was something about the whole company that you wanted, like their customer base or their knowledge, or the fact that they were a competitor and you want them to stop competing with you. I mean, whatever it is, there's something that would cause you to pay more than the price of the chairs and tables and trucks. Well, that extra you paid goes on your balance sheet as goodwill. And then you write that off over time. You have a depreciation schedule for your goodwill, which is way too complicated to discuss today. You can get your doctorate talking about the various philosophies behind writing off goodwill. But the point is, it would show up on the balance sheet as an intangible asset. But then I want to get to the things that don't show up on the balance sheet, that really are possibly the whole reason you're such a good business. And even though you're not going to put them on your balance sheet, this is the time while you're writing your balance sheet to think about these things. What are you good at? What are the things that make you special, that cause you to even go into the business, right? Your core competencies. I mean, if we teach strategy, one of the things we say is the best strategies are the ones that build on your core competencies, that don't require you to create new ones. Although, of course, you're certainly welcome to create new ones. But the best strategies build on the core competencies you have. So write them down. Don't put them on your balance sheet, but write them down. Think about what are you uniquely good at. And right along with that are the next two, advancement along the learning curve, right? I mean, think about Tesla versus Ford, right? Ford's got a bunch of EVs now, including their very popular F-150 truck. But they had to learn a lot of stuff that Tesla already knew. And that's why Tesla is selling more EVs than Ford is, right? It's not about production. Ford can build them fast. They've got big factories. But Tesla just is so much further along the learning curve, and they have so much collective knowledge And you can bet when they meet in strategy sessions, they write this stuff down. Also, there's a customer base. I mean, how many Tesla customers are going to go buy an electric vehicle from GM next time? I would say very few. I mean, it'll happen for lots of reasons, but generally speaking, once you got them in a very specialized product, you got them. And so it's worth explicitly noting this, even though, again, you won't write it on your balance sheet. Branding is another, and actually, you can go back to Tesla for that. If you were doing a word association game and someone said electric vehicle, wouldn't you say Tesla? Even if you never bought one, never wanted to buy one, right? The first thing that would come to your mind would be Tesla, right? Somebody said soda, you'd say Coke, even if you drink Pepsi, right? It's just branding is because branding exists in the customer's mind. It doesn't exist in your company. That's why you don't write it on your balance sheet, but it's damned important. You also may have an advantage with geography, right? Think about Coors beer, right? Coors, one of the reasons that they say their beer is so good is they have good Rocky Mountain water. And being in Colorado, I can attest to the fact that the water is really good here. You don't have to filter it. You don't have to do anything to it. It's great to drink. But the fact is, you can copy this. You can do a chemical analysis of Colorado water, and you can copy it anywhere. And you can make your beer taste like Coors, and even though you made it in New Jersey. But it doesn't matter. Coors has the geography advantage, and they know it, and they brag about it. And it exists in people's minds as one of the reasons to drink the beer. Michael Porter, many of you may not have heard of him. He was very famous maybe 20 years ago. He still writes and speaks, but I think his analysis is evergreen. It lasts a long time. I'm partial to Michael Porter. I served for a while on the President's Council on Competitiveness in Washington, D.C., and Michael Porter was the guy who actually led our session. So I got to meet him. I did seminar series in Japan on Michael Porter stuff. I actually found his stuff fully translated into Japanese. I guess it's probably translated to 40 languages. But if you're using some of his tools, and here's a very complicated chart, but this is right out of his book. This is one of the charts that made him famous. And the point of the chart is, if you can do some of these links, like they show procurement linking to inbound logistics, personnel management linking to production, things like this. If you can do it in a way that other people don't see it, it's not in full view, then they can't copy it, or they're not as likely to copy it. And then you have a strategic advantage that you're going to have for a long time, right? Now, if it's something that people can copy, they will copy it, or at least they'll try to copy it, right? And so you look at companies that are hugely successful, right? You look at Amazon, right? So Barnes & Noble tried to copy Amazon. Borders tried to copy Amazon. Borders isn't around anymore. Barnes is around, but they're on a banana peel every year. And their physical stores are wonderful. I love hanging out in Barnes & Noble, but they're not going to survive forever just selling me coffee while I read books for free. So there are things that Amazon did that nobody understood. And now that they understand it and try to copy it, it's almost too late. So again, these are things that none of this goes on your balance sheet. But when you're thinking about your balance sheet and thinking about what's special about your company, these are things you really want to put to paper, give a lot of thought to. Okay, so now let's move to the right side of the balance sheet, the right column. And we start with current liabilities. These are liabilities that you're likely to pay within a year. So not going to convert to cash within a year. They're going to use cash within a year. And the most obvious is your accounts payable. It's money that you owe your suppliers, your vendors, your credit cards. And we're going to talk about the cash conversion cycle because that's what's really important about your accounts payable. And just some definitions, I already mentioned these, but I wanted to put them on a slide so you have it in front of you. before we go to the cash conversion cycle. So the inventory, as I said, you look at your average inventory and divide it by your cost of goods sold. And that tells you how many days you have in inventory. Your receivables, your average or ending receivables, divided by your revenue, tells you how many days for that one. And payable, again, we look at the average or the ending, and we compare it to cost of goods sold again, rather than to revenue, because that's the cash you use on your payables is the cash, the cost of goods sold. And so here's your cash conversion cycle. And I tell you, I looked at loads of, you can Google this and ask for an image. And I looked at loads of them. I couldn't find one that's perfectly in focus. So I don't know. I can only say that this is the closest I could come to one that's got crisp enough writing that you can read it easily. But essentially, across the top, these are things that happen before you can get paid, right? So you order stuff or you build stuff, right? Then you sell it, right? So you see sale, delivery, invoice right at the top in the middle. And then you wait to get paid, right? And then finally you get paid, right? And that can be days, weeks, months, depends on your business. But then on the bottom is your money going out. And I think without any deep study, you can see there's something wrong here. You made those payables really quick and you haven't been paid yet. So you're going to go into your credit line, or you're going to, reduce your cash on hand. And the time it takes from when you paid until you get paid, we call the cash conversion cycle. And you can see one of the nice things about this chart is not only shows the average days in receivables, it shows that even when you make that phone call and they say, okay, a week from Tuesday, you'll have that check. It's probably going to be 2 weeks from Tuesday, right? The mail delays, the intentional delays. And so what we want to do is we want to shorten that cash conversion cycle. And the best ways to, well, first let's look at what we can do at the top. Well, we can make those phone calls. We can, encourage our clients to pay. In an extreme case, you might have to turn them over to a collection agency. But hopefully you will never have to do that. But don't be afraid to do it if you need to. You want to get paid. But also maybe you take credit cards, right? So credit cards are going to charge you a fee, and it could be as much as 3%. That's a lot of money, but they're going to pay you the same day. And then they're going to have the burden of chasing people. Or maybe you're going to borrow money with your receivables as collateral, right? That's a good thing to do. If your receivables are good receivables, you can go to a bank and say, I've got $20,000 in receivables, and generally I get paid within 30 days, and I can prove it. I'd like to borrow 10,000 against that 20. You probably could do it, and that would be a way to turn that. But then you'd still have to collect on it because you just use the receivables as collateral. But another thing you can do is what's called factoring. We actually sell the receivables to somebody else, and then they're not a collection agency necessarily. They're just a factor, could be your bank. And then they'll go out and do the collecting. But you're going to sell it at a discount. The discount's going to be more than 3%. So it's not as good for you as it would be taking credit cards. And, it's easy to take credit cards. You can do it with all sorts of handheld devices. I needed a new battery in my car yesterday, and the car was still in the garage. AAA comes, he starts the car, he puts a new battery in, he has a little handheld device that says hi to my phone, and he's paid. It's that easy to take credit cards. On the payable side, though, you can stretch those payables. And I'm not suggesting that you agree to pay in 30 days and then pay in 60. Although some people do that. I'm saying agree to pay in 60. Explain to your vendors that you can't pay in 30 days because you don't get paid in time. And or at the other end of it, say, all right, I'll pay you in 30 days, but I want a discount. Give me 10% discount. We're paying 30 days, and maybe you'll get that. So you get the 10% discount for paying in the 30 days. Then you give up 3% to the credit card company, So you have the money and you're 7% to the good. And it's really not that hard. But you're not going to do it unless you go to the trouble of drawing out the cash conversion cycle. And this is the time when you're writing up your balance sheet, looking at how much you have in receivables and how much you have in payables. Do this math, draw this out, hopefully with a little less fuzziness on the writing. And it'll just pop out in your head. You'll see that there's so much you can do that will improve your cash position and maybe even improve your profit as well. And then we distinguish notes payable from accounts payable. It's very similar, but rather than this being money you owe to a vendor, this may be a loan you got from the bank or from your credit card company. Usually there's a contract involved. There may be interest, penalties. You may have put up collateral. So we put it on a separate line. And generally you may even want to have a separate line for each note, not just have it all clumped into one, because you want to see how you're doing. So maybe you have 3 different loans you're paying off. Mention all 3 of them separately as a line item on your balance sheet. And, if after today you go online and you look at the balance sheet for a public company, you're going to find that all of these things, everything we talked about, is going to have multiple lines. They're not going to collapse everything into one line because they want to see how they're doing, and they know that their investors want to see it as well. Then you have wages payable. And this is a big deal because in a lot of states, you better pay the wages on time. If you're going to delay somebody, this isn't the somebody to delay. And even if you pay regularly, you're still going to have wages accrued. Because let's say you pay every Thursday, right? But you don't pay to that Thursday, you pay to last Friday, right? It's very common, right? So you're going to pay it on Thursday, you're going to pay it up to what you worked last Friday. Well, then you have 4 days right there that you still have to show as wages payable because you didn't just pay them. And likewise with benefits, let's say you're paying your employees health benefits, or you're paying them to be members of a club or whatever it is. You're probably not going to pay that every week. You may pay once a quarter or once a month. And so you're going to accrue that as well, just like your wages payable. And these things you accrue, even if you're on a cash taxpayer. Remember, we talked about you could have different tax books and GAAP books, depending on whether you are an accrual taxpayer or a cash taxpayer. And a lot of young companies are cash taxpayers, but they still accrue things. So we still use the word accruing, even though they're not accruing it for tax purposes. They're still accruing it because they owe it. And you still want to, you never want to lie to yourself. You want to be brutally honest with yourself. What do we owe? When do we owe it? And where are we going to come up with the money? And right along with that, this list could go on off the page. You could think of 50 million kinds of taxes that you owe if you're in a business. And we know that these are not optional, right? And you got to pay them. The payroll tax is what you pay, so people will have Social Security when they retire. You as an employer, you pay half and they pay half. It's about 7% of their pay. You obviously owe income tax on your profit. And sales tax is a really tough one because you're going to owe sales tax in every jurisdiction where you do business. And it's going to be different. It could be 7% one place and 6.25% in another. And you don't want to go through a sales tax audit. You want to make sure you understand what that is and you accrue for it at a tax that's due. And like I say, you can think of others. This list could go off the page. But the important thing is don't forget any of them. They're all liabilities, and you don't want to go through any of these as an audit. Then we look at our long-term debt, and we say part of that long-term debt we're going to pay this year. So it's not long-term, it's really current. We have a mortgage, maybe it's a 30-year mortgage, but you're going to make a payment every month. So part of that is a current liability. Likewise with leases, maybe you've leased all your trucks. They're all on 36-month leases, but every year, you're gonna pay 12 of those 36 payments. So we put that down as a current liability, and the same with a payment plan, is you're paying part of it. It's common sense, but I think people forget. They say, well, a mortgage is a long-term debt, and they don't plan for the fact that, well, you still have to pay it every month. And even if let's say you go to a furniture store and they say, 24 months, same as cash. So well, that's great. I have to pay this for 24 months and no interest. You didn't read the fine print. You have to pay it every month. They're just not going to charge you any interest if you pay it off in 24 months. But you still have to pay monthly payments, and you want to be sure you've recognized that in your planning. And then your other liabilities are the long-term ones. So we start with those same three: the mortgages, the leases, and the loans with payment plans. But now we recognize that the rest of it's going to happen in future years, and maybe some of these even have balloon payments where maybe you have a 30-year mortgage, but you agreed at year 10, you're either going to refinance it or pay the whole thing off. And we call that a balloon payment. And as I said, if you have two sets of books, then you'll have deferred taxes as a long-term liability. And generally, the way one set of books is different from the other is a different depreciation schedule. There isn't much else you can do to make your tax books look different from your GAAP books. It's usually in depreciation. As I said, if you follow the rules, it's legal, and you might even keep finding ways to defer that tax on into the future to have new depreciation. Okay, so as we said, we know what our stuff is. We've hopefully written down the intangible and very intangibles, as well as the stuff that goes on the balance sheet. We look at everything we owe, and whatever's left, just like in the house, that's our equity. So where did the equity come from? Well, it started out with contributions we put in when we started our business. And whether we put it in as cash to sit in the bank, or we contributed stuff, or we took our cash and bought stuff, as long as the stuff is worth more than the money we owe on the stuff, it's part of our owner's equity. And of course, if you're a public company, you're going to sell stock to the public, and that's going to increase owner's equity. And this is, again, one of the odd things about the way we do accounting. Generally, we show stock sales on two lines. So let's say you sold the stock for $10 a share, but the par value of the stock was 10 cents, which makes no sense. But for various crazy reasons, we said the par value is 10 cents, right? So we would show it as two lines. We'd say we sold stock at par for 10 cents times the number of shares. And then we call the rest additional paid in capital of $9.90 times the number of shares. And some companies still show that as two separate lines. Some companies just put it all together and say, this is crazy. The par value of a share of stock means nothing. But either way, you look at other companies, you're going to see that you may sell stock without selling it on a stock exchange. Maybe you bring family members into your business and you say, I'll give you 10% of the company for $10,000 or whatever it is. That's part of owner's equity now, and it's a stock sale. You still need to show it on your balance sheet as selling stock. So it doesn't necessarily mean you sold it on a stock exchange or with a broker. It just means you brought in money from someone other than yourself, and you need to recognize that on your balance sheet. And then how does your owner's equity change? It changes with retained earnings. So the retained earnings are the earnings that are after tax, not paid out as dividends, right? And if you're a small company, you may not pay anything out as dividends. On the other hand, if you're a sub-S corporation or an LLC, maybe you want to give yourself some dividends. But anyway, whatever's left that wasn't paid as dividends is retained by definition. And that changes owner's equity. It can go up or down. So if you had a profitable year, your retained earnings are positive. If you had a loss year, your retained earnings are negative. But remember, it doesn't necessarily equal the cash, because you could retain the earnings and immediately buy new trucks with it. right? So it was still retained earnings. Your equity went up, and so did your assets. You have these new trucks that went up on the asset side. And so since you didn't finance those trucks, your equity went up as well. So that's how your retained earnings increased your equity. It doesn't necessarily mean it increased your cash, although it could. But I know a lot of people are fooled by this, and certainly a lot of my students were. You can't spend the retained earnings unless it is actually cash. Just like you can't spend the equity in your house unless you turn it into cash with something like a home equity line. So it's an important part of accounting. It shows how you're doing. It doesn't necessarily mean your cash went up, but you certainly want positive retained earnings. Okay, so you built the whole balance sheet and you say, okay, now I look at my balance sheet. I turned a lot of these individual entries into flows. So how am I doing, right? And, I changed this slide a few times. I started with, how am I doing? And then, because that's what you would say yourself, but then I decided, since I'm delivering this, you don't really care how I'm doing, you care how you're doing. So I changed it, but really we care about how you're doing. And so there's a lot of measures for how you're doing. I'm just going to talk about two of them. One is return on invested capital, or often referred to by its letters, ROIC. It's a very simple formula. It's your net operating profit after tax, right? So it's not all your profit, because we are only caring here about how much money you made as a business owner running your business, right? So you may have made interest on money you had in the bank, right? You may have made interest on lending money to your brother-in-law. That's great, you did that, but that's not a return on your invested capital. It's not something from your business. So we want to look at your operating profit after tax and divide it by your interest-bearing debt plus your owner's equity. So it's almost everything on the right side, but it's not counting your wages payable and your money that's going to go out right away. And the reason I like return on invested capital as opposed to return on assets is because we're looking at, we put capital in the business, we don't really care where it came from. We want to see if we're earning as a business on that capital, and we want to make sure it exceeds our cost of capital, which is another whole webinar if you don't know how to figure that out. But we want to be sure that we're earning more than our cost of capital, right? If we're not, then we're actually destroying our business. So even if we have earnings that we're paying tax on, if we're not earning at more than our cost of capital, we're paying taxes and we're actually shrinking our company. We don't want that to happen. It's kind of like if you had a bank account that paid you 5% interest, which you actually can do now. It used to be a joke to say 5%. But you're withdrawing the account at 6%, well, it's great. You're earning 5%, but your account's going to get smaller every year because you were drawing it down at 6%. The same with a business. If it's costing you 5% to bring capital into your business and you're only earning 4%, well, your business is going to get smaller. And then finally, we want to say, okay, we figured out what owner's equity is. We know what it means. How did we do on our owner's equity? And so now we look at all the income, not just our operating income, because it all accrues to us. We look at all of our income, we divide it by our owner's equity, right? So the income was a flow, but we can look at what it was for the last year, divide it by our owner's equity at this second in time. And it actually comes into, you can break this down into 3 categories. How much do we make on each sale? How much selling did we do with the assets we have deployed? And how much leverage did we have? So that we can magnify the return on our assets. And so if you want to make your return on equity more, you have to look at what can we do? Where can our business do better? Can we borrow more? Can we have more financial leverage? Can we do more sales on the assets we have? Or can we make more on every sale? Can we raise prices? Right? And those are important questions, and they have their own sets of answers for each. Several years ago, I wrote a case study on Starbucks. And the question, I posed it to my students, and then we wrote this case study up. And how can Starbucks improve its stock price? And when you look at these three categories, we say, well, they can't do much in the first category, right? Because they're already charging through the nose, right? It's the most expensive coffee in town. Maybe there's a little room to charge more, but not much. And they really don't want to do a whole lot with financial leverage. They're borrowing as much as they're comfortable with. So how does Starbucks make more money and improve return on equity and hence their price of their stock? They do it with the middle one. They sell more with the assets they have. And if you ever spend time in Starbucks, and I spent a lot of time in Starbucks, you'll notice that every Starbucks has a dynamic line, right? And the line kind of goes to the door. Usually doesn't go further than the door, right? So if you're thinking about having, well, should I stop at Starbucks and the line's at the door, you probably won't stop. Now, this is different at 8 in the morning when everyone is caffeine deprived and will do whatever it takes. But generally speaking, you're going to make a decision about whether to join this dynamic line. So what does Starbucks do? And you'll see this. They weave the line around the store. They don't let it go out the door because then they can have more of a line in the store and sell more with the assets they have, right? The other thing they do is once they have you in this long line and they know you're caffeine deprived, so you're not thinking that carefully, they sell you stuff you don't need, right? And again, I don't remember the exact numbers, but if you pay $3 for a cup of coffee at Starbucks, they will give you a mug. They don't expect you to hold your hands out and pour the coffee into your hands. No charge, you have a mug. On the other hand, you can buy a mug for $20 while you're standing in line, and then the coffee will be free, right? $20 for a mug and free coffee, $3 for coffee and a free mug. That sounds like a no-brainer, but in your caffeine-deprived state, that mug seems like a pretty good deal. So they sell mugs, right? So all this stuff is in that middle space where they can improve. And I wrote this case study and sent it to Howard Schultz back when he's the CEO and he was the founder of Starbucks. He left for a while, but he's back there again. I sent it to Howard Schultz and we got a phone call from their VP of store operations that this is the stuff they pay attention to. And so this is the stuff you should pay attention to as well. You've written out your balance sheet, you have all this information, you can say, how am I doing? And how can I do better? And these three little equations here are one of the best ways to decide how you can do better. So that's how you build a balance sheet. I hope it's been useful. It's a process you can follow. And if you'd like a mentor, and we told you at the beginning, we want to tell you again, just get on the website. We can help you get a mentor. It can be a mentor in your local area, or it can be out of your area. The only real benefit of a local one, of course, is you can more easily meet in person, but you can always meet by Zoom and by phone and by email and text and whatever else is good. And of course, also on the website, you can find all of our previous webinars, including this one, which is being recorded. So we're going to send you a survey. Ask you how we did. Surveys are complicated. Just say we did great. You don't have to figure out what all these words mean. Just check the grade column. If you want someone right away, here's a little QR code you can scan. Diane and I are sitting in special chairs. So if you scan this code, we get an immediate electric shock and we will immediately help you find a mentor. So scan the QR code. Other than that, we have some time if we have some questions. Diane?
There are mentors standing by. Is that what you're saying, Alan?
Yep, standing by. I remember
Standing
Sesame
by
Street
to
did a routine on, you have operators standing by, really?
Well, they didn't lie back in the day, Alan, so there must have been operators standing by.
Yeah.
I have not seen any questions coming in. I've been looking on both the chat and the Q&A screen and don't see a question on either. You mentioned something about collecting receivables. We are having a webinar in December on reducing leakage.
Reducing leakage. Getting some
Yes.
plumbers in to talk, huh?
Well, it sounds like a plumber talk, but it's actually reducing leakage relative to receivables and how you can collect more of your receivables. So that's a webinar coming up. But Ellen mentioned that this is the third in a series of webinars, and you will be getting, in addition to the link to today's webinar, you'll be getting the link to the previous two webinars on financial statements and financial directions. So look forward to that email and the links to it. Tiffany says she's going to need some time to let this sink in before she can formulate a question. But Marianne is also saying this has been very helpful. And I thank you, Alan, for your time and sharing your knowledge with us. No more questions. So I think we can, Charles is saying it was excellent, fabulous. Thank you, Charles.
If you have questions later, you can apply for a mentor and say, you know, I just want to ask this question, right?
Sure.
You can even ask, could I be your mentor and answer the question? It doesn't have to be that you need someone to hold your hand for the next 5 years while you grow your business, although we're happy to do that. We have some great success stories. But even if you have just 1 or 2 questions, you can still get on the website and ask your questions and we'll get them answered.
Absolutely. And you can specifically ask for Alan if you'd like, if you feel that he would be a good person to answer your question. So I think that without any further questions, I'm going to say to our attendees, thank you so much for coming. We have weekly webinars. Since you have attended one of our webinars, you will be on the mailing list. And I hope that you would think about signing up for additional webinars. And lastly, I want to thank Alan. You did a great job. That's a tough subject, but you broke it down into little pieces, and I think we all understand it a little bit better. So thank you, Alan, for your time and energy.
Thank you.
All right. Goodbye, everyone. Thanks for coming.